Hi everyone. Thanks again for continuing to tag along in this journey of learning how to apply R to finance and finance ideas. So this week I believe should be a pretty simple video. We're not going to do a whole lot of data manipulation. However, what I am going to do is introduce regression in R and also introduce another type of figure closer to the end of this video. But with that said, the packages that we're going to use for this are going to be all the same that we have for the past, I think, 2 or 3 videos. So you'll notice some familiar faces here. The Yahoo Financer or Yahoo Finance R package, Tidyverse, Lubridates, SQL just as an option for you to use in your own work, but we're not going to use it for this video in particular. The ReadXL library, and also a new one called FixEst, which is short for fixed effect estimation. There is a lot of statistical terminology that is helpful to understand when using this package. However, I'm not going to introduce fixed effect models, random effects models, or cluster standard errors or anything in this video. I just want you to know that that is something that you can do using this package. I'm going to show you the syntax closer to the end, but really the main thing I want to do is just give this to you as a tool for use in the future. It's a tool in your tool belt if you need it, because it offers many more features than the normal LM, the base LM for regression models that base R offers. With that said, let's jump straight in. I'm going to load these libraries and set the same working directory that we've used in the most recent videos. And the thing that ultimately what we're going to do is build up to implementing the capital asset pricing model, which is, in a nutshell, just a way to predict individual asset or portfolio returns as a function of the market returns. And the basic or the theory is pretty much parallel to something that you would see in chemistry, biology, physics, where we are trying to explain something that we see in nature, the nature here being financial markets, using a theory where we have a left-hand side variable. That variable is the individual assets' excess returns over the risk-free rate. And the dependent variable, the right-hand side, is the market's excess returns. But I'll explain that in a little bit. With that said, the first thing that we're going to do is just use Yahoo Finance to gather our S&P 500 data, because that's going to be our that's going to help us build up to the right-hand side. The code from lines 13 through 25-ish, this is all stuff that we've seen before. I make a call to the Yahoo Finance API. I collect some data over a time period. Here I'm using monthly data from 1999 to 2020, or through the end of 2020. The data that I really care about, though, are the 20-ish years of returns from 2000 to 2020. But I do want my first month of 2020 to have a return associated with it, which is why I start my time series 1 month prior. So I collect the data, and this is similar to what we've seen before. Monthly price data. I got close prices, high prices, low prices, volume, etc. And I'm going to manipulate it by retaining just the date, giving a month identifier, a year identifier, a month no, and getting my previous values, my previous close prices, so I can get a holding period return, assuming that I would hold this data from 1 month to the next month. Here you can see the original raw data, and the SP500 object is the manipulated clean data frame that we're going to base everything else that we do upon. The column of interest that we really care about, though, is HPR. Close out the data tab, and now we're going to repeat this process, but for another individual asset. This could be an ETF, this could be a stock, It could be a portfolio of your own design. But for this case, the asset that I want to use just for this example is Coca-Cola. And it has the ticker KO. Instead of using the index new call objects, I'm going to use the ticker new call from the Yahoo Finance API package. I'm going to call this object Coca-Call. Repeat the same get history function to call my Coke data into R. And then I'm going to use the same manipulation on the Coke data as I did with the index. And now if I compare KO, which is my data frame of Coke returns, to my SP500 data, you can see it is pretty much identical. The only thing different is the SP500 data frame has this first observation, which has a missing HPR. And you'll notice the reason that is because I did not include this last step, the filter step up here with the SP500 code. So if you care enough, what you can do is go back, copy and paste this highlighted part of the code up with the SP500 step. And what that'll do is just make these two data frames consistent. However, it doesn't really matter. I'm going to keep it the way it is, just so you can just see that for some of these things, it's not necessarily going to matter in practice if you have missing data. Sometimes it does, sometimes it doesn't. It just totally depends on whatever your specific purposes are. Well, now what I'm going to do is aggregate my data up to a yearly aggregation. I could do the CAPM at a monthly level, but just for simplicity, so I can work with a smaller number of observations, I am going to aggregate my data up to the yearly level, which lines 44 through 54 are the exact same as we've seen in earlier videos, where I call an object, group it by year, and then I run some summary stats, which give me a geometric return. I count the number of observations, and I identify my annual volatility. I want you to notice, though, the only thing that differs between these two steps is the variable names, where, like for example, in line 46, my S&P 500 yearly return is called SP underscore ret underscore year, but in 52, I call it KO underscore ret underscore year. The idea is the same, but I have a little bit of foresight about what I'm trying to do, and ultimately I'm going to merge these two data sets together. But let's run these codes, or this code, and just compare the data sets and see how it looks. We'll call this open up KO yearly and SPY yearly, and lo and behold, everything's identical except the SPY has this first observation with an NA value. But the ideas are the same, and from here we can rest assured that our two data sets are comparable, barring the differences in underlying data. Well, next, because I know in the CAPM model I need to have excess returns, I need to incorporate the risk-free rates. But just like in previous videos, starting with video 3, excuse me, 1 second as I give my dog a second to finish barking. Oh, it looks like they're going to keep on going, so give me just 1 second. So sorry for that, the little bit of barking that you probably got in the background for a second. We have 3 dogs, and as you can imagine, it's very difficult to control all 3 of them and to keep them even-tempered while I'm trying to make these videos. But nonetheless, recalling in the CAPM model, we need to have excess returns both on the left-hand side and the right-hand side of our model, our regression model, we need to have something to subtract from the market returns that we computed in line 46, and something to subtract from the Coke returns, the asset returns in line 52. Well, good thing we already have a data frame of risk-free rates, or a data set of risk-free rates. So I'm going to pull this in. And if I pull this up, you'll notice this is the same data that we've been using for the past handful of videos. What I want to do, though, is merge each of these data steps together. And one of the cool things about the tidyverse set of packages is the set of join functions. The left join, right join, inner join, anti-join is a unique one, which we could do in SQLDF with using actual SQL code, but these join functions tend to be a little bit quicker if the data are cleaner. Well, if you look at this data, it's all pretty clean. I have matching observations or I have 3 data sets that have all the same year, just different additional columns. Which all I'm going to do is tell R to join each of these columns on the year. And what's going to happen is something that's going to be super beneficial to us. So if I just pause here for a second and read this code, starting in line 59, what it's going to do, or what we're telling R to do, is say merge KO yearly and risk-free rates on year. And if I rearrange these data frames in order of the way I type it, I'm telling R to find a match in risk-free rates or RF rates and KO yearly on year and nothing else. Because I have unique observations by year here, what R is going to do is find the observation from KO yearly in the year 2000 and RF rates in the year 2000, and then bring over all of the variables associated with the year 2000 into this KO yearly data frame. Whenever you're dealing with the left join, what you're doing is essentially saying, hey, take everything from my left data frame and then take only from the right data frame what I care about. Which here we're not specifying anything specific, so it's going to take everything. The next step, now remember, this pipe operator chains together multiple steps, and my steps here are left join, and mutate. You'll notice that I have another left join, but only one object that I'm referencing. Well, what this pipe operator is actually doing in the background is feeding the object referenced in the previous step into the next step. So you could essentially imagine this as saying, hey, the objects I get from this first step is going to be called KO yearly, which all I'm doing here is just rewriting the data set of yearly Coke returns. And then I'm joining it again with my SPY yearly data set. And then what I'm going to do is mutate 2 variables called XRET and market XRET to be just the returns less the risk-free rates, which by definition is what an excess return is. And if I fix my formatting here and I run this, you'll see what I mean. See, it was super quick. Granted, we have a super small data set, but if I open up a data frame, I have all of the variables that were in each of the respective objects by themselves. For example, I have the Coke specific data, the risk-free rate data, the SP 500 specific data, and now an individual asset excess return and a market excess return for each and every observation. All right, so now we can do the capital asset pricing model, which if we if I type down what this model is, you'll recall that it's the expected return of some asset I as being equal to the risk-free rates plus the beta for the specific asset times the return on the market less the risk-free rates, which if we want to be super specific, this would be the expected return on the market, which with observational data, we proxy for this as being the market risk premium, and whenever we put the CAPM into a regression framework, we'll use excess returns on the left-hand side as well. You could think of it as the operational form, or how we operationalize it. Where we call this like the excess returns on the left-hand side as returns on the individual asset less the risk-free rates as being equal to some alpha plus the beta of the asset that we're going to estimate times the return on the market less the risk-free rates plus some error term. Now let me say where this is going to be operationalized in a regression framework. Now I don't want to give an in-depth review of regression. There are plenty of great resources online, plenty of great intro stat classes that I don't want to spend too much time reinventing the wheel. But the basic idea, the thing that we're going to do is try to predict some left-hand side variable using some right-hand side variable. Now, we really want beta because beta is going to tell us essentially the unit price of risk. And the risk in specific terms that we care about is the market risk, or really how sensitive an individual asset is to overall fluctuations in the market. And there are plenty of great modeling softwares. You can do this in Python, SAS, Stata. You could do it in SPSS. You can use anything. However, I love R, and I hope that you're starting to love R as well, because there are so many great additions to R, which we can easily implement to approach different types of problems. For example, if we were doing more advanced statistical modeling, we'd be doing something called fixed effects, or we could implement fixed effects, or we could cluster our standard errors to account for or correlations within a time period or over time periods. We could do what's called instrumental variable analysis or anything along those lines. Now, one of the worst parts about R is the base programming of the language does not allow for that. However, there are a handful of packages, one of which, or arguably the best of which, is the fixx package, which houses the function FEOLS, or fixEffectOLS, which, if you want to use this syntax that I've commented out, allows you to do all those things. Whenever we're doing a capital asset pricing model, we don't care about all the extra fluff. I just want to introduce you to the existence of this package, because if all goes well and these videos continue, I will probably end up showing some of these additional things that you can do, or you may use it in your own research or your own career. But the basic syntax in R for any regression model is like this. We're going to regress some dependent variable on some independent variable coming from some data set. This little part of the code I incorporate here is just telling the FEOLS function that I don't have any fixed effects. I believe we could ignore this, like meaning we could drop this out entirely and we'll get the same results. But whenever you know that you can input a placeholder and not change your output, it's great practice to input like a null placeholder, which the 0 here would be the null placeholder. Now, if I run this, if you're on a Mac, maybe you can say command return, or if you're on Windows, as we already know, it'd be control enter. You'll notice I get an object denoted as a list, and if I open up this list, I have a bunch of different nested objects. Some are integers, some are environmental variables. I have more lists, I have doubles, I have more lists, which house our coefficients and other statistical terms that are important for our analysis, our standard errors. So everything that is powerful in a regression model is now nested in this data. It's nested in this object. And we can see the coefficients pretty easily if we just want to say summary CAPM. R will output what our intercept is, which is the alpha that I mentioned earlier, and it's going to give us a coefficient for each variable that we include in the model. Because we only have one variable, marked at xret, the coefficient associated with it is beta, or the asset sensitivity to the market. The summary function is great. However, I like to have more control over my output because in other regression models or other types of models, there are a lot of other important statistics. Like for example, you can also think of it this way. Within this object, there is a lot of data, and maybe you don't care about everything. I like to have control over my output, so when I use the FEOLS function, I also use a sister function called eTable. And the syntax is pretty easy. The first thing I need to do is give it a list of all the different objects I want to compare. So I could estimate another model, call it CAPM2 or CAPM3, and I would just type those in as well if I had them. There's no limit. You have control. And then I'll tell it the statistics I want to include, notably just the number of observations and my adjusted R-square value. I'll tell it the stars that I want to associate with each level of statistical significance. So I'll give it 3 stars for a 1% significance level, 2 stars for a 5% statistical significance, and for a 10% level of significance, I'll give it 1 star. I want to round all of my digits for both my coefficients that are estimated and my stat digits, meaning like my p-value or my t-stat. I want to round to 3 digits as well, so that way I don't have this ugly looking blur of numbers, in addition to including some other information like titling my output. I know this is a lot, and there are actually a lot more different options I can include, but if you're interested in using the eTable function, you can always go to help, type in eTable, and give it a second. It will pull up all of the different options that you can customize which you can look at the lower right hand side of the screen and see there are a lot of different options with a lot of different details associated with them. But that's neither here nor there. I just want you to know that it exists. And if we switch our attention back to the syntax and run the eTable function, notice my output's a lot cleaner. It tells me what my dependent variable is, gives me a coefficient associated with my constant, gives me a coefficient associated with my independent variable, excess returns on the market, tells me the number of observations used to estimate the model, and my adjusted R-squared. If you're interested in talking more or learning more about how to interpret coefficients, how to make proper inferences from them, I am more than happy to do this. Feel free to shoot me an email, drop a comment, just tell me that you're interested in doing that, and I can either make another video about it or share some great resources about those topics. But I am just going to assume, for the sake of the rest of this video, that you're up to speed enough to make inferences about the statistical significance. But with that said, if we turn to the coefficient for the market X variable, we can see that Coke has a beta of 0.567 when estimated on yearly data from the year 2000 to the year 2020. At least I believe it was 2020, right? Yep, to the end of 2020. Which, recall from a basic investments textbook or basic corporate finance textbook, or just by definition, beta is the sensitivity to the market. And when beta is greater than 1, that tells us that we should expect higher returns for this individual asset for a given change in the market's returns. But on the flip side, if beta is less than 1, the asset's going to have a smaller change in its individual returns for a given change in the market's returns. Or in other words, when beta is greater than 1, it's going to scale up market risk and market returns. If beta is less than 1, it's going to scale down the market's risk and the market's returns. In this case, Coke has a beta less than 1, which means fluctuations in the market are not going to bleed over as much into Coke's expected returns. This is sort of a measure of correlation, but what it's trying to do is tell us about how the market prices market risk, or how investors price market risk and Coke's expected returns. And here we can make the inference that investors in Coca-Cola, when the market increases its returns, the broad market's returns increase, Coke's returns are also going to increase, given the fact we have a positive beta. But the increases in Coke will not be as great as the increases in the market, because Coke is less sensitive to the market. And you can see this in two figures. So you can see this in a scatter plot where we plot the individual assets returns relative to the market's returns, and if we plot the coefficients, if we plot beta and alpha, you'll see like the line of best fit, or a regression model that tries to relate the two time series. So let me make a quick adjustment to the code and make my market excess return the X variable, for my GM point function, you'll notice everything in lines 81 through 85 are the same as what you've seen in the previous video, where ggplot tells R that we're going to plot some data, KO yearly is my object, geom points is a type of plot that I want to produce, meaning a scatter plots. AES relates some X variable to a Y variable in addition to other options if we have them. Geom AB line produces a straight line. The intercept is going to be my alpha. The slope is going to be my beta. Here I'm going to call the CAPM objects another object within the CAPM list called coefficients, and say the first element within the list, or the first element within the coefficients objects, is going to be my intercept. We know this because if we run CAPM $coefficients, it says the intercept is what I'm looking for, and it's the first element. I'm going to annotate some text on my figure just so I know what I'm looking at. Use the black and white theme, center my title, and then give it a title. Nothing new here. And wouldn't you know it, we have points that represent each of the pairwise relationships between the market's excess returns and Koch's excess returns over the risk-free rate. And the relationship is positive. It seems to be fairly broad of a relationship. It's not a super tight-fitting line, but there is some positive sensitivity to the market, which is what the beta represents. But you'll notice we don't have a line with a slope of 1%, which would be a perfect one-to-one relationship between the individual asset returns and the market's returns. And it's also not steeper than 1, which would mean the individual assets returns have a greater sensitivity, or will have more fluctuation in relation to the market's excess returns. If that's not super intuitive, I get it. It does take practice, and it does take a lot of dwelling to really let these ideas sink in. However, this idea sensitivity, I think, makes a lot of sense when we consider a time series plot. Whenever we plot both the individual asset returns and the market's excess returns on the same figure over the same time frame. And what we should expect is when an asset has a beta greater than 1, the high points of its returns should be greater than that of the market, and the low points of its returns should be lower than that of the market, because the beta is scaling up or scaling down risk. If an asset has a beta less than 1, the market movements, or it's the patterns that we see, if there's a positive beta that's less than 1, are going to look similar to that of the market, but the asset's returns, the highest returns will not be as high, and the lowest returns will not be as low. It's going to be more condensed, if you will. So once again, we're going to call ggplot, but now we're going to use 2 geom line functions, both with the same x variable, the year, both different y's. And this is going to tell R to give me 2 lines based off of 2 different time series. One I want to have as the assets excess returns, and the other I want to be the market's excess returns. I'm going to tell R here to color it the Koch returns red and the market returns blue, and use the same theme black and white, the same theme function and the same labs function. Now when I plot this, you'll notice Pretty much exactly what I just said about the relationship between the highs and the lows. Coke is plotted in red, the market is plotted in blue. The relationship co-moves pretty heavily. When the market increases, Coke also increases. When the market decreases, when the market decreases in blue, Coke also decreases. However, there's a big caveat. The fluctuations in the highs, or Coke's highs, are never quite as high, or are hardly quite as high as the market's highs. On the flip side, Coke's lows are rarely as low as the market's lows. Like the perfect example is in 2008, we had the financial crisis, but Coke's low was not quite as detrimental as it was to the broad market. Of course, there is variation. I understand that. But if we were to extend our time series, you would see this pattern tends to hold relatively true. Granted, this is all based off of the CAPM model. If we change the model, this relationship may also change. However, that's a conversation for a different video whenever we talk about the validity of different types of asset pricing models, the proper statistical functions to use, etc. The purpose of this was really just to give you an introduction of how to do a regression in R, how to kind of sort of interpret beta, and how to plot a couple of interesting relationships. Now, as always, if you have any questions, feel free to shoot me an email, drop a comment on the video, etc. And I am more than happy to meet you where you are and provide additional details. Now, with that said, be on the lookout for next week's video, or just for the next video in general, and I look forward to seeing y'all's progress and hearing how things are going. Thanks, y'all.